Hello, I'm leading the team at AfricaPay, and today I want to share a vision in this explainer that is absolutely set to redefine what banking means for the Ugandan diaspora. We're diving deep into a strategic framework designed to establish Housing Finance Bank, or HFB, as the primary global institution for Ugandans worldwide. We're going to look under the hood at the data, the mechanics of cross-border liquidity, and the actual technology required to make this ambitious goal a reality.
Right now, when a Ugandan moves abroad to work, study, or even just to visit, they largely leave their native bank behind. They rely on expensive third-party remittance services to send money home, and they're forced to open entirely new accounts with foreign banks just for their daily coffee, their rent, or their transportation in places like London, Dubai, or New York. We are here to challenge the absurdity of this status quo and ask a very simple question: why? Seriously, why should a customer's relationship with their primary domestic bank end the exact moment they board a flight at Entebbe Airport?
The sheer scale of this disconnect is literally staggering. Consider this: there are over 2.5 million Ugandans living abroad right now. Together, they remit nearly $2 billion back home every single year, which drives immense family support and national economic growth. Yet, despite this massive capital flow, over 70% of the Ugandan diaspora do not accumulate savings within the formal domestic banking system. Their wealth is being generated globally, but it completely bypasses the domestic ledgers that actually need it most.
To solve this, we're outlining a core solution, a strategic partnership between AfricaPay and Housing Finance Bank. This introduces the Digital Local Currency, or DLC framework. You can think of the DLC program as the ultimate operating system designed to transform HFB into the primary global bank for Ugandans worldwide. And to be clear, it's not about opening physical brick-and-mortar HFB branches all over the globe. Instead, it's about enabling HFB to obtain retail banking access through partner banks in those destination countries under one single unified infrastructure.
What we're talking about here is a complete paradigm shift. Our goal is to move way beyond the limitations of mere remittance services and encompass a seamless day-to-day retail banking experience. Right now, most diaspora banking initiatives just focus on reducing transfer fees or maybe speeding up settlement times. But true offshore banking, that means offering the diaspora a daily utility. The vision is for the HFB mobile app to actually be more convenient and feature-rich than the local banking applications in their host countries.
In the hands of the consumer, this whole thing feels like one unified digital space. By deploying the DLC program's virtual presence capabilities, HFB can provision diaspora users with regulated, onshore virtual accounts that are natively denominated in their host country's currency. So, whether that's Saudi riyals, US dollars, UAE dirhams, or Turkish lira, it doesn't matter. All of this sits beautifully right alongside their base Ugandan shilling account in the exact same app.
To understand how we pull this off, we have to starkly contrast archaic banking models with modern infrastructure. Traditional correspondent banking relies on legacy nostro and vostro accounts, which, fun fact, translates from Latin to ours and yours. Now, these are highly restrictive, pass-through accounts, primarily built for wholesale clearing and B2B settlement. They trap capital in volatile local currencies and simply do not support direct retail capabilities in foreign jurisdictions. The DLC framework, on the other hand, provides a full domestic current account held in the foreign bank's name. It grants full non-resident virtual presence, allowing direct API integration right into a host country's domestic payment rails, meaning full retail control without needing a single physical branch.
So let's break down the technical architecture real quick. The DLC framework operates purely as an infrastructure layer, handling all those complex cross-border integrations and regulatory burdens across three main pillars. First up is buy. That's the acquisition phase where users digitally purchase local currency through regulated channels. Second is keep, which provisions that regulated onshore digital wallet securely on HV's ledger, effectively preventing capital flight. And third, spend or accept, which is the cashless loop that connects that onshore wallet directly to domestic payment networks like local QR systems or mobile money rails.
Now, why is this three-pillar system so desperately needed? Well, out of an estimated $5.3 billion flowing through inbound corridors to Uganda, formal retained assets, like savings and mortgages, only account for about 26%. That means a truly shocking 73.62% of this capital fails to remain in digital banking ledgers. It gets immediately terminated as physical cash. We are talking about roughly $3.9 billion currently being lost to unmonitored shadow economies and informal halala networks. You know, those ancient trust-based money transfer systems that operate entirely outside of traditional banking.
When we actually look at where this demand is coming from, this scale is just massive. The United States leads with $1.15 billion, followed closely by the UK at $580 million and Saudi Arabia at $420 million.
This highlights the absolute massive scale of the capital capture opportunity here. If HHV can capture even a fraction of these specific corridors digitally before the money gets diverted through informal cash channels, the liquidity gains for the bank are going to be staggering.
Now, I know what you might be thinking. How does HFB manage the crazy currency risk across all these different nations? It's a great question, and the answer is the neutral reserve and T+1 settlement model. Under this framework, HFB maintains its capital reserves securely in stable hard currencies, which completely eliminates balance sheet exchange rate risk. When a retail transaction actually happens, it's settled against a pre-funded buffer. Then, the Treasury Department utilizes a T+1 or 48-hour window to source the necessary Ugandan shillings at optimal mid-market rates, zero expensive forward contracts, and no complicated hedging instruments required.
Section Real-World Global Journeys, the United Arab Emirates. Let's ground this with a real-world journey. Imagine a Ugandan worker residing in the UAE. Instead of dealing with multiple different banks, they just use the HFB app natively. Thanks to the API infrastructure provided by a UAE host bank, they receive their wages digitally right into their HFB virtual account, fully compliant with local UAE wage protection systems. They spend in dirhams for their local rent and groceries using an HFB card. And when they want to fund their home construction back in Uganda, they instantly and seamlessly convert dirhams to shillings right within the app, crediting their domestic mortgage account onshore without paying any exorbitant remittance fees. It's just total, absolute convenience. Section Real-World Global Journeys, the Outbound UK Student. For this demographic, the crucial point is how the capital remains within the Ugandan banking system while still serving outward needs. A student traveling to the UK can literally open a UK-compliant virtual account and get a debit card via the HFB app before they even leave Entebbe Airport. Their parents back in Kampala fund the account locally using Ugandan shillings. The system then maps this funding to a British pound buffer. So when the student buys a train ticket or pays rent in London, it's a seamless local card swipe in GBP, but the initial capital was entirely captured and retained formally within HFB back home. Naturally, operating across multiple global jurisdictions like this requires absolute security and compliance. This seamless user experience is fortified by a truly enterprise-grade backend. To protect against network timeouts, the system uses strict idempotency keys, which, honestly, is just a technical way of saying a user is never double-charged if a connection randomly drops. And compliance is handled through advanced fraud and anti-money laundering, or FRAML, behavioral biometrics, ensuring full regulatory adherence right across borders. When we pull all of this together, the strategic dividends for Housing Finance Bank and for Uganda as a whole are truly transformative. First, you have global deposit capture. HFB benefits from the daily transactional turnover of the diaspora before the money is even remitted. Second, by making the formal digital channel the absolute path of least resistance, it actively bankrupts those informal hawala cash markets. And finally, as the institution commanding a 60% share of the domestic mortgage market, HFB can channel these new, low-cost digital deposits directly into funding long-term mortgage assets, directly attacking Uganda's national housing deficit of 2.4 million units. This all leads to our ultimate goal. For the Ugandan diaspora, the result of this infrastructure is total convenience and profound loyalty. Whether you are studying in the UK, working in the UAE, or trading in the US, our vision is remarkably simple, but entirely paradigm-shifting. There is no reason for Ugandan anywhere in the world to use any bank other than Housing Finance Bank. Thank you for joining me for this explainer today. I want to leave you with a fascinating question to ponder. If this digital borderless infrastructure succeeds here in Africa, could this be the blueprint that finally makes the traditional high-fee remittance industry globally obsolete?